We're still dealing with QE4 and the inevitable shock that this is attempting to cover up underneath this rotten financial system. Today we are watching more economic indicators month after month weakening, stagnating, or simply looking dismal. Printing digits into a computer to then buy US debt and garbage toxic assets will not in any way support the economy. Anyone who spends just 10 minutes to actually look at the data would know this. But instead, we have a very large majority of the public that is highly uninformed and would simply prefer to leave it up to the suits and ties to ensure that their interests are taken care of. Sadly, this will not end well for many. You came here for the truth, so let me unveil that for you. I have an extremely jam-packed episode to get into today. So much information. We're going to look at what Ray Dalio said. We're going to talk about the Federal Reserve, the ECB, quantitative easing, quantitative tightening, interest rates, everything in between. Let's get into it right away. Ray Dalio says the world is in a great sag and echoes the 1930s. This is a continuation of what he had said more recently, essentially saying that we are mirroring a time frame in the 1930s right now that could end in disaster. Everybody knows what happened after that. It remains to be seen the way that things will, of course, unfold, but it is very interesting to see how certain patterns do repeat. I, for one, love to look at all of the different patterns that we have seen historically. Some of my favorite times have been learning about history and seeing how that has progressed. Seeing how it then mirrors into a future event is certainly something to behold. I'm going to get into some data from the Federal Reserve, beginning with this. You can see their balance sheet and the fact that in late 2014, the Fed stops printing money. Everybody knows this by now, but what most don't know is that the ECB went and fired up the printing presses. Late 2014, the ECB starts printing. So as soon as the Federal Reserve stopped, the ECB simply picked up the pace, and globally, central banks continued to print money. And let us not forget the fact that the Federal Reserve didn't just eliminate its balance sheet. They were holding $4.5+ trillion on that balance sheet that we were publicly allowed to know about. And that means they are staying in the market consistently to ensure that they maintain that balance sheet. The ECB wasn't the only one, of course. Other central banks were also doing the same. Most of the attention happens to be on the Federal Reserve for obvious reasons. However, other central banks out there are printing up trillions upon trillions of dollars worth of fiat garbage. None of it, of course, has ever in any way supported the economy of any country. But what it does is it transfers the wealth from the average person to the globalist elite. 5 months of QT, quantitative tightening, undone in 5 weeks of QE, quantitative easing. Something very interesting that I don't think is being reported into the media is the fact that this has been a surge upward. I'll show you the most recent information coming directly from the Fed website, the Federal Reserve's own website that gives us the most recent data available. This happens to be updated on October 17th. Just wanted to show you that it is inching ever closer to $4 trillion. Before the financial crisis, it was below $1 trillion. They said they would expand this temporarily, just like all of the other things that they do. Income tax is going to be temporary. Our recovery process is going to be temporary. Everything else that they put into the media to make it seem like everything is going to be okay. Don't panic. Take a look at what's happening all around the world. We are seeing the rumbling in the streets. And I talked about this in the community section on my channel. And I know that there are so many people out there, whether they're from Chile, whether they are from Ecuador, maybe they're from Hong Kong, so many other places that are truly experiencing the madness. Fed Vice Chair Richard Clarida reiterates that the Fed is not locked into a set interest rate path. Of course, the market doesn't like to hear this, but we can see the direction which they are going. It is cutting rates, it is printing money, it is making this easy monetary policy even easier. I have shown you this 1,000 times before, I'll move on. What's happening right now in the financial system, as well as the stock market more specifically, is that there has been a huge change. We have watched more money dumping into what they believe are safe assets, and we are seeing risk taken off the table in some cases. When you look at this here, it has been an unprecedented change that has been going on depending on the statistics. When you see this, maybe let's say the second half of 2018 up until present day. This is connected with that information. Passive proliferation slows as 770,000 indexes scrapped in 2019. If you can believe this or not, there are 2.96 million indexes in the world, and that is actually down 20%. So we have all of these different companies out there that create these indexes. You're looking at all these ETFs and all these different ways that you can create something out of nothing. When you see the actual real asset itself, and maybe you want to consider that this particular company, that's an asset. A business is an asset. But then you create a derivative of that, and there are shares in this particular company. Then you go even further and they create a mutual fund, let's say. Well, you don't necessarily own the shares anymore, but you own part of a fund that owns some shares. And then you could take it even further. There are other examples with ETFs. And now Charles Schwab is able to give you fractional investing. You can invest in a fraction of a particular stock. All of this is getting the individual further and further and further away from the asset itself. This is not a good sign for what we will see. And connected with that is this chart here, record bond inflows, record equity outflows. Remember what I just said here, record equity outflows, okay? Most people don't know what the hell is going on, but this is in fact the case. You can see this data from the EPFR, many different websites use this information. You could see it in the mainstream media on occasion. Look at this yellow line. That is the global equities all throughout 2019 so far. This has continued. I know it doesn't seem logical because you can see what's been happening with the prices of certain stocks, and you would say, seems like everything's fine to me. We're closing in on all-time highs. How can this possibly be? But when you see the actual data, the actual information, things start to make a lot of sense. This blue line is the global government and corporate bonds. Of course, people are trying to get into safe havens, and this is what they believe, at least in the financial world, is more safe than equities. When they want more risk, they will pile on more equities. When they want more security, maybe they're going to go to bonds instead. We had seen a huge influx of money with all of these IPOs that came out, and then Uber launched their IPO and it was a big mess. They opened up their books and people realized this company is simply burning money. The thought is that at some point in the future, they'll be profitable. This is going to be the next big thing because of this technology, because of this factor, and so on. Other companies did their IPOs and we saw terrible results. The one that has done really well has been Beyond Meat, though it is down significantly from its peak. WeWork didn't even get to that point because as soon as they opened up their books, the valuation started dropping dramatically and it is now at $8 billion. Now you might think to yourself, $8 billion, that's a lot of money. However, as they point out in this article, it's a slim fraction of the $47 billion valuation that they initially got from SoftBank. This tells you what's happening to the market today. People do not want to take the risk that they once did. This is an extremely important chart that I wanted to show you. I've never seen this comparison before, but I would like to find this on a regular basis if I can for you. Spike in global economic policy uncertainty could translate into more volatility. When you measure volatility using the VIX index, you're never going to see volatility. Okay, it's just a simple matter of fact. We know that the Federal Reserve has admitted to a short position on volatility. We are aware of that. You're not going to see it come up in the VIX index. That is simply a fact. You can see the global economic policy uncertainty, which is the orange line, spiking to a record high. Higher than Lehman Brothers, higher than all of the prior events since the 90s, as you see here on this chart. There are so many events going on globally right now that could spill into any economy, and yet we do not see that in the highly touted indexes and different economic indicators that are always going to be there for people to misjudge. It's truly unfortunate. Despite the fact that I am probably the most criticized channel out there, even though all I'm doing is showing articles, showing charts, simply stating data that I find, I collaborate that into these videos, and we have people that literally subscribe to the channel just to post hateful comments every single day. Although the psychosis is expanding, it still surprises me to see it day after day after day. You might not see it, but if you look through the comments, I assure you there are always hateful people out there. Look, this is the fact. HSBC to cut up to 10,000 jobs to slash costs. We have seen Deutsche Bank. We have seen Commerzbank. We've seen so many different companies out there that have been slashing jobs. I understand some companies are hiring, some companies are firing. I'm just bringing you the information that they generally don't want to put on the front page news. Take what you want from it. I am just showing you what I believe is truly important. Now, 3 things really quickly. This just shows you a breakdown of what companies are doing right now. It splits it up into the buybacks, the dividends, cash acquisitions, R&D, CapEx, showing you everything that you need to know and what they predict for 2020. If you can believe it or not, it actually shows you here that there is more money going into these stock buybacks than basically anything else. Shareholder return now equals more than 100% of the free cash flow. S&P 500 trailing 4-quarter cash return to shareholders as a percentage of the free cash flow. You could see it going over 100% here in this chart. I'm getting some conflicting information on this. I'm trying to get the right data for you, so I show you different sources and we can somehow average it out, but it shows you in this case here, Goldman Sachs, buybacks declined sharply year over year during the second quarter. It is massive any way you measure this. However, I was told that back in 2018, the buybacks were 1.1 trillion, but in these reports, it's showing us more like 800 or 850 billion. Regardless, they're suggesting that although the levels are unprecedented so far in 2019, it is down from 2018. Either way you look at this, it's unbelievable to see what companies are doing right now, financing these stock buybacks, which push the stock higher and higher and higher, all with debt. Debt is the new wealth, apparently. Unfortunately, for a lot of people, they don't use it in the way that these major corporations are able to. Not a good sign. That's all for this video. If you found it informative, give me a thumbs up. When you give me a thumbs up, you are supporting this channel, so I do appreciate that very much. If you want to make money, if you want to build a business, I have a free e-course which teaches you how to sell on Amazon. Definitely check it out at the amazongps.com. If you want the financial education that was withheld from you during your education when you were supposed to be learning about this, these 2 books have all of that info that you need. They're simply written, no jargon. They explain everything with diagrams and simple writing. Both of these are so important to take a look at. You can do so in the link in the description. If you want the audiobook, that's at themoneygps.com. So you stayed to the end. Well, thank you very much for doing so. Have you seen this video yet? If not, truly important to get this data. Check it out. I'll see you there.